welcome. Good to see everybody again this month. Welcome back. A lot of regulars at this point, so it's fun to see the same names, even the ones who changed their names for amusement. Thank you. Let's start off with a long-term trend. Last month it was not too bad. I mean, we had a good run up here. Data was saying pretty good, but then very, very quickly it fell apart, and I'm not even really sure why. Because back here the market sold off much worse than it did here, but the data was just accelerating really, really bad. So we'll have to see where this goes, but I'll show you next charts on how that all fits together. The midterm cycle is negative 1,000. This is like, when we built this indicator, 800 was like an extreme negative, right? And we're now negative 1,000, and that kind of breaks it off the end of where it's supposed to be, which is weird. The last time we saw that was actually in January this year, when things kind of were selling off pretty quickly and heavily then. But that's such a rare reading. What's hard to tell right now is, are we just oversold, or are we there's something big underlying that's a problem that we're just not seeing yet? We know that put buyers, people betting against the market institutionally, are more than they have been pretty much ever, including 08, including earlier this year, including the COVID crash. The numbers are staggering if you see how much money is betting this market is going down right now, institutionally. Is that a contrarian indicator, meaning we're at the bottom, or something brewing that we're just not seeing yet? I'm really curious about this. But the data is saying things are ugly, really, really ugly underneath, and we're not really fully experiencing that in the markets just yet. Here's the S&P. Kind of interesting. Here's what I was talking about, is the sell-off that we had about a month ago, a couple months ago, was very swift and fast and ugly. And the data really didn't show too much of a sell-off. But here, it had a very, very aggressive, watching the money flow come out of the market. But the market, this drop wasn't nearly as bad as this one, or even earlier before that. What was also really interesting is this little bear trap right here. We talked about those in a previous video or previous month, that you get these setups where everything looks really positive. Even down here, we had a little blue arrow, which meant on this chart, we have several indicators lining up saying that, yeah, the momentum is in this direction. And then, boom, fooled you. And then the market sells off. And we're kind of doing that again, just like here. And what's interesting is Will's done really good research on this as well, is that you get bigger movements in bear markets. So yesterday we had a really big up day, but in the context, that's really not a big day. This was a much bigger down day. The biggest negative days tend to happen after the biggest down days, so they kind of offset each other. So really a good market is smaller up days, smaller incremental steps forward, moving forward. Really good. There was an example back here somewhere that I thought was fantastic. Here. We had 1, 2, 3, 4 days run up, and then boom, one day just takes it all out, really 2 days, and then it washes it out. So that's the kind of thing that happens when the trend line is moving down and the price is happening below that. So that's something we're definitely paying attention to, right? So we could have a good day. We could have a good day again today, although I think we gave up the gains last I saw. But we could come up to here and then have one day that just wipes it down and pushes us all out below that number. So it's really dangerous to be too aggressive right here, but it's something we're watching, and the momentum is all still negative right now. So see where that goes. As far as sectors, the only positive sector is utilities. That is not a positive thing for the market. All other sectors are negative. The worst is communications, which is the Facebook, Google, that sort of place. It's like a variation of tech now for some reason. But you can see the MACDs have been negative for quite some time, for a couple of weeks anyway. Last month when we were here, I think when we did the newsletter, these were mostly positive. So we've had a shift back over there. And the rotation has been happening much faster than it does in normal times. We'll see things go from a couple of weeks on one side to a couple of weeks over here and then back. And it's just been almost jarring, but it's been interesting because we started watching in a relative rotation graph, which is this. And I think I had this in the newsletter. If I don't, I do use it on Twitter. If you're not on Twitter, you can follow me there. Ryan Redfern, CMT. So here are all the S&P sectors, right? All of them are in the lagging box, right? And this is all relative to the treasury bills. Some call that the risk-free rate in traditional finance. All of them are weak and lagging the risk-free rate, so that's not great. The positive note is utilities. It's trying to not fall into that area. And energy has been just kind of crazy and off the chart in every direction. It's been wild. So it's coming down, and we'll see where it goes, but it's not real promising either. But one positive note, and actually Christine found this, I think kudos to her, was that she did a study looking at every sector of the market in September, and just about all of them were down except for energy. So we are watching energy as something that we may want to buy for this month only, a little more aggressively than we normally would. But the rest of the market, the odds of positive are not real good for September and usually into the beginning of October. So we'll have to see how that plays out. But yeah, right now everything is down here. When a month ago, when things were all good, we were kind of curving up into here, and these all rotate in a circle. So it's really interesting to watch this all play out over time. But yeah, we all fell out of the green, which is when it's leading T-bills, and now we're lagging, and we're kind of waiting for it to come into approving, and then we might see a time to be buying in the market. But right now, no. You want to wait until these improve enough over T-bills, not just because they're pointing up. So we have a little ways to go there. And then finally, this just fascinated me personally. The green line is the S&P in 2008. The blue line is the S&P this year. First part, it definitely followed it, and then it was worse. And as of right now, we are worse than it was in 2008 at this time. And I'm not saying the economy is worse like it was then, but it's just fascinating to watch similar or areas that felt similarly bad, but we're just not seeing it yet in our economy now. We've had the two negative quarters of GDP, falling. So we should be in a recession technically. There are people arguing against it and saying, well, no, unemployment hasn't gone up yet, but it's starting to. We're starting to see that, and that is the next big thing. So if unemployment starts to take off, do we see this year's S&P drop like it did fourth quarter? It was September, October of 08, and that's when things got really bad. I don't know. It may or may not. There are factors that could say no, but the more the Fed talks, the more we see data coming out, it's not real promising, and big money is betting against this market. But those all could be contrarian indicators. So I really don't know. But that's where the data is telling us, and that's where we are as of today.